There you
Okay.
go. Go back to your screen, my friend. So we're going to be talking about the multi-leg
Trade analyzer.
trade analyzer. Right.
And this is, so I brought up SPY. And what this tool does is separate all the multi-leg trades in the options from the single leg trades. And a multi-leg trade, many of you will trade like a call spread or put spread, butterfly, and you'll enter it in as a multi-leg trade, meaning that you need to get executed on all sides simultaneously in order for that trade to get executed. So once we separate them and we have them in this bucket, the question is, okay, well, what was the strategy? And on the trade tape, it doesn't really report the strategies. Even if you enter a call spread, the Oprah feed doesn't identify it as this was a call spread. They just give you the legs and they tell you these are part of a multi-leg trade. So by looking at these trades, we would have to analyze this as the most likely strategy. Okay. And then once we analyze it and group it, we can then create these reports. So in SPY, we could see that there are 77 different strategies used by options traders yesterday. So we're on June 3rd. We're not open yet, so this is as of yesterday's close. There are 1.1 million contracts that traded yesterday involved in multi-leg trades. And we had over 10,800 unique combinations of strategies. Okay, so even a call spread is a strategy, but you could have different call spreads because we have different expirations, different strikes. So over 10,800 unique combinations. So let's just click on that. And now we see all the different types of strategies that we detected. So you could see up top here, put spreads. They were the most popular strategy yesterday. 497,000 contracts in SPY traded yesterday that were involved with put spreads. And there were 2,387 different combinations, meaning if there's on different strikes, different expirations, you could have many different types of combinations. And if we click on that, on this put spread, this will filter out all the put spreads that traded. This is the top 5. You could scroll through, to the next ones. And this is sorted or defaulted by the most volume. So these are contracts here. So what we see here is this top one from 10:47:22 to a.m. to 1:12:35 p.m. we detected trades in this particular put spread, July 19th, 497,501 put spread. And it traded 4 separate times. Okay, so this particular put spread traded 4 times yesterday for a total of 80,000 contracts. The put spread has 46 days to expiration. So we just put it here to make it easier to figure out, especially if you're just scrolling down, if you opened it up like this, and you wanted to look for, longer dated, shorter dated, you could do that. This one has 46 days to expiration. This here, the strike spread is the difference between the 2 strikes. So here we have the 501,497 put spread. Well, the difference between those strikes are $4. Sometimes you'll have tighter ones. You could have wider ones. Here's a $20 put spread, the 480,500. But this just makes it easier instead of doing so many of them in your head. Let's go back to the top 5. This indicator here, the H1, is saying that going back in time, we've seen this put spread historically trade at least one other day before yesterday. Okay. And we could go back and look at that one as well. This is the volume weighted average price of the put spread. So if we took all the put spreads that traded yesterday, the traded prices, and weighted them by the volume, the weighted average price, the VWAP price, is 45 cents. So this $4 put spread traded at 45 cents. If we did the same thing to the bid and the ask, so if we looked at the bid of the put spread, the MBBO bid, and then the MBBO ask, and weighted it by the same volume weighted schema as the trade, we could see that the bid was 45 cents, the ask was 49 cents, indicating that this put spread was trading on the bid side. And the reference price of the stock, same way, we weighted it 522.77. All right, so then we have these details up here, which we could quickly just scan. Here's one that was same. If we go down one at 405.47 to, so this traded after 4 o'clock. The next one down, 80,000 contracts, traded 5 times. Same expiration, July 9th. You can see here it's slightly different. It's the 497.502 strike instead of the 501.502 strike. 46 days to expiration, $5 between the 2 strikes. That's the difference. That traded two times historically, and this one traded at 43 cents. And this is the bid and the offer, 39 cents, 43 cents, with the stock price 527.62. Gives you an idea where some of those top put spreads are trading. And if we opened it up, the details, so I'm going to open this. Now this gives us more details about this put spread. Now the most current market, this is the most current market, is 31 cents bid, 35 cents offer, which means that from this 45 cents were traded, now it's getting marked. If we mark to market, around 33 cents. So the value of that put spread went down, right? When we look at option prices, they're marked to market because they don't trade like a stock. The option prices will move with the stock, even if there are no trades in the options. How do we value those options? We use the midpoint as the fair market value. The midpoint here is 33 cents. It traded at 45 cents. So now we see that it's declined by the end of the day by 12 cents. Okay. These are the summary stats. So the last price it traded at 45 cents. VWAP 45. It did trade as low as 36 cents. The high 45 cents. And if we want to open that up, we could get more details here. So this is what happened by the end of the day. This is the 497 put. This is the 501 put. So we see these are the bids and offers at the end of the day for each put. These are the implied volatilities. The open interest in the morning for each leg. So you can see 40,650 contracts for the July 497 put, 43,590 contracts for the July 501 put. And in both instances, the open interest declined, but there could be other stuff trading in there besides these options. So that's something to consider, because this probably was not the only trade that that traded yesterday in these particular options. SPY trades a lot of options, so we'd have to go and look through everything. But the open interest nevertheless declined today. Now we see it traded 4 separate times. Okay, so these are the 4 different trades yesterday.
Hey, D.
Yeah.
Sorry to interrupt, but a question came in from Rob, and it's on a little bit of a delay. So he's asking, is there a click that can load the spread into the current calculator from this screen? Rob's asking.
No, that's a good question, and that is something we are looking at right now to try to go right from this screen, click over to the options chain that you could run your analysis. It's not available yet, not on this version, but that is something that we are looking to add as an additional feature. So the idea there is, if I'm looking at this put spread and I want to run it through an analysis, a payout diagram, a theoretical value, look at the historical chart, just to go from this screen and have it set up to make it easy, with a click. That is something we're working on, but as of now, you'd have to go and set it up yourself in the options chain. So you have to go in the options chain and actually, set up this put spread and then run the analysis. But we are looking into a, one-click solution that just takes you over and populates the legs for you.
Perfect.
Yep. So let's come down here just to analyze it a little bit more. And here we see that it traded 4 times. The first time was at 10:47:22 a.m. and that only traded 2 contracts for 36 cents. And that happened on the CBOE. So if we click on that, we could see the details. These are the different legs. So this is from the time and sales. We could see the timestamp. Here are the 2 legs. Here are the prices, 1 contract on each. This is the prices. This is where the bid and offer was on each leg. Right? This is the implied volatility each leg traded, and the open interest on the CBOE and so forth. And it was on a price improvement auction. So that was the first trade. It was a two lot, nothing else traded until 1:12:35. And then you could see at 1:12:35, let me just close this up. At 1:12:35, it traded 3 times. So 3 times it traded at the same time. What is it 3? Well, you could see here that it traded on 3 different exchanges. 40,000 of those contracts were on the CBOE. The next one, 20,000 were on the Philadelphia Stock Exchange. That's the PHLX. Then 20,000 traded on the ICE exchange. Okay. And if we opened up the details, then we could see here are the prices, notional value, and you could see here that these traded on the ICE exchange. So if you open this one up, this one traded on the PHLX. Okay, so it was on their complex order book. Why they trade on 3 exchanges, not 1? Maybe this big order was trying to access liquidity, and it had to go to multiple exchanges that have competing market makers and specialists to get the entire fill, right? Because you have 40,000, 20,000, 20,000. So going to multiple exchanges, maybe CBOE, that's all the market makers were willing to do. Then you have to go to the other exchanges to get it filled. It doesn't look like a floor trade to me, so it looks like these got executed electronically on the complex order book. Let me just take a look at this one. Same thing here. That's how it got executed. So let me just close this up. There's too many open. And another detail here that we have is the delta of the spread itself. So this delta has it's 60,000, 30,000, 30,000, right? So if we go to it, what does the 30,000 delta mean? Well, you could see here that, you trade 10,000 contracts with a 19 delta, 10,000 contracts with a 16 delta, so the difference would be 3 delta times 10,000 contracts times 100 per contract. So you get that 30,000 delta. So each side, depending on which side you have, has a 30,000 delta, long or short, depending on which side you did. But it's a pretty sizable delta, given that. What does that mean? Well, all these, just without this 3 lot, is 120,000 delta, meaning that if the stock moves $1, right, up or down, the options, all these options put together, right, whoever did all of them, the value of that strategy is expected to change by $120,000, okay, for a dollar move. So those are the option deltas here. So one more thing here, we see that there was another instance historically that it traded at least one time. So if we click over here, we see on May 31st, okay, this is a historical date, May 31st at 4:07:56. So after 4 o'clock, we see 76,000 contracts traded on this spread. So this is yesterday's June 3rd, right? This is yesterday's trades, June 3rd. But we also see on May 31st, this same spread traded 76,000 contracts for 34 cents. Okay, so this was, you could see here, the trade VWAP price 34 cents, with the market 30 cents, 36, with the stock at 527.30. If we open that up, here we see that the open interest increased on those dates. We'd still have to go see what else traded, because you could see that the open interest changed, but by different amounts relative to, where this volume, because the volume is 38,000 on each side. Maybe this one's close, changed by 37,000. And just eyeballing this, just looking at the prices, eyeballing it, what may have happened is that it looks to me, without further, that at 4:07:56, after the market, I guess in SPY, it's not after hours, but after 4 o'clock on May 31st, with the stock at 527.30, it looks like somebody came in and bought this spread because it's closer to the dealer's offer. Now, if the midpoint, if we use the midpoint as the fair value, and it traded, which is 33 cents, and traded at 34 cents, closer to the dealers, somebody came in, looks like maybe purchased this from the dealers, and I'm eyeballing it here. And then if we forward then from May 31st back to yesterday's, now it looks that perhaps this same spread, just because the quantities are very close together, looks like perhaps they sold this back out. So the market declined, right? Let's look at those stock prices again. the market there was 527.30. Now you can see here the reference price 522.77. So the market, oops, you can see here declined, right, from 527.30 to 522.70. What did the put spread do? The put spread gained like what's that, 11 cents in value based on the trade prices. Went from 34 cents to 45 cents. And if those two are related, we could go look at, the open interest a little bit closer. That looks just like a flip, right, of a put spread where the market declined between May 31st and June 4th, and this put spread gained 11 cents. So there's that analysis. We're right up at 9:30, Will, so I'm going to stop it there.
Awesome job, D. Rob's very thankful that you're working on new features to attach to this. He was happy to hear that. Thanks for the questions, everyone. Thanks for joining us. Great job, D.
Thanks, everyone. Stay safe out there. Have a great trading.